want to ask you, so you started this fund called Cowboy Ventures. Can you tell me a little bit about it? And you're really into this idea of investing in Life 2.0. And you could tell us what that trend is all about.
I'm happy to. So Cowboy Ventures is a startup. It's a startup venture, a seed fund, basically. So I spent 13 years being an investor, kind of a traditional Series A, Series B, and a little bit of a late-stage investor at Kleiner Perkins for a long time. And over the past 3 or 4 years in particular, actually even like maybe 5 years ago, a great guy named Steve Anderson who has a fund called Baseline Ventures. We started together at Kleiner Perkins in '99, and he and Michael Deering and Josh Kaufman and a bunch of other guys have been kind of starting to do more institutionalized seed investing. And as a Series A investor, I was seeing more and more companies that actually had gotten a combination of kind of professional and individual angel seed financings. And they were both kind of, I think, better prepared for Series A, but they also had made a lot more progress coming to us as Series A investors. And I felt like a lot of what seed investors had the opportunity to do was do a lot of kind of what venture firms used to do in the old days when the rounds were a lot smaller and the firms were a lot smaller and investing was kind of a very personal, hands-on business. And so I was a little envious. And so I was fortunate that a year ago, basically, with the support of my partners at Kleiner, I was able to start a $40 million fund to focus on seed investing and being kind of a good, hopefully a top hands-on institutional seed investor, and then help these companies and entrepreneurs get ready for a great Series A. And so I think one of the things we talk about what we do is we are big believers in Life 2.0. So it's maybe a little bit similar to how Mary Meeker talks about how we're in this like the reimagination of everything, or other people talk about how like software is eating the world. Like I feel like software eating the world I'm a big believer in that, but I feel like that's a little scary. But I am a believer that like pretty much everything you do in your life, when you wake up in the morning, you used to turn on the TV or go out the front step and get your newspaper, right? That's just like the way you get information and the way you start your day is changing because of technology. It's more likely that you reach to the side of your bed and you pick up your iPhone or your iPad and you get your news through a much more personalized, tailored service like Flipboard or Twitter or TechCrunch. And then throughout the day you go to work, how you take notes, right? I don't know how many of you use Evernote or something like that, right? Like we used to all use notebooks. I was like a crazy copious note taker, and now I use Evernote for everything. How you get your lunch, even things like that. Right now, it used to be that I would make my lunch or go out for lunch. Now I can fluck my lunch, or I can like hasty my lunch, or eat club my lunch. And then, how you shop, how you communicate with people. I just think that pretty much everything in your work life and your personal life is being like kind of touched by software in some way. And those are the kinds of companies we're looking to back.
So you talked about being a hands-on investor, but it really depends on what you're doing with your hands. Vinod Khosla yesterday at TechCrunch Disrupt said that he thinks that 70 to 80% of venture capitalists actually add negative value to the startups that they work with. Yeah. Do you agree?
I don't know if I'd say 70 or 80, but negative. I don't know about that. I would say, one of the things that has been really nice about having the startup is like, I don't have a lot of legacy. I don't have a lot of politics or overhead. So I've kind of been able to start with a clean slate. And one of the things that we did this past summer was we did a CEO survey, right? Where we sent a survey out to we've invested in about 12 companies so far. And then we have a lot of friends who are kind of Series A or seed stage CEOs. So we sent the survey out to about like 50 early stage CEOs. And we basically said, like, what should we be doing? What are the, if you've had like VC or seed stage investment before, like what are the best things that those people have done for you that have actually moved the needle for you? And actually, what are things that investors do that actually like are annoying and you wish they would stop doing it? And we got very, very frank, this is all anonymous and confidential, very frank, detailed information about like annoying things that investors do, or like the top 3 things that people have done to be most helpful. And so we try and make sure we're aligned with those things. And then we're trying to measure.
It'd probably be useful if you told us some of those things.
I mean, I would say there were things like, over-promising and under-delivering, right? Like, I think setting expectations is really important, like post-investment, how are you going to help, and how are you checking in with them? Or a lot of times it was...
So basically, don't say you're going to do a whole lot for them and then not answer email.
Or like, don't not call me for a quarter and then ask me to give you like all your metrics and all your financials because you have to do a report to your LPs, right? Stuff like that. And then don't make random introductions. Like, hey, my neighbor's got this son, he needs an internship, would be really great if you could hire him. Like stuff like that. There was just a lot of that, and then a lot of the help was like recruiting is often top of the list, right? Because these are small teams where it's a co-founding team of maybe 2 or 3, and they just need to get to 6 or 7. And a lot of times it's hard because they don't need VP level people who've run 100 people. They need like the one iOS engineer who's kind of a 10x engineer, right? And those people are really hard to find, and often investors don't know those engineers. So that's kind of a hard thing for investors to be able to help with, but that's what like, a lot of startups want the most. They like when we're proactive and that we actually call them and say like, hey, how's it going, rather than like just asking for stuff the other way. And then we asked kind of like, what's our NPS score? Like a lot of web companies use kind of a net promoter score, which is kind of like how likely customers are to refer the company minus the detractors, like how likely people are not to recommend them. And so we kind of said like on a scale of 1 to 10, how likely are you to refer us to other friend, like a good friend who's an entrepreneur? And then if we weren't a 10, what would we need to do to be a 10? And there's lots of things that a lot of you, if you're individual investors and you spend a lot of time looking at ventures, you know that there's like a humongous number of seed stage companies out there, and we try and meet with as many of them as we can, but it's really hard to be super responsive, like within 24, 48 hours to get back to people, because a lot of times also you're kind of noodling it over and you don't actually want to say no right away, but you're not ready to say yes, and I think that's a delicate balance of making people feel like you're being responsive and that you're giving them a fast enough yes or no, but you're also giving yourself time to actually do some diligence.
That's a pretty tough thing to balance, actually.
Yeah.
You know, because you don't want to just do nothing, because then they think they don't even know if you read the email.
Right.
But if you say no too early, you might lose an opportunity. And if
Yeah.
you say yes, you might get yourself into something you're not that into.
Exactly.
So do you send them an email being like, hey, I'm thinking it over, like give me a few days?
I do.
Okay, cool.
I do.
Well, moving on from that then.
Okay.
You all, another cool insight I think you gave is that when you do introductions, make sure you ask both people on either
Right.
side if they want the introduction to be made before you connect them. Just like throwing like one of your friends' phone numbers into a message to somebody else, I think is actually really irresponsible.
Exactly.
And it puts a lot of pressure on them. That's sort of needless.
That's one thing I changed actually after the survey. Was like, instead of just making intros, I sent an email first and said like, hey, I met with this guy. It seems like there could be a fit. Do you want to talk to them? And I make sure it's cool first.
So, you talked about what not to do,
Yeah.
but how do you add value? I think that's what's really critical is if you're going to be an investor, people don't just want your money, they want
Right.
some added benefit.
Yeah.
What is your value add?
Well, I think what I think it is, I mean, obviously like the entrepreneurs are the people who have a better sense, but I think one of the things I can be helpful with is because I have been a Series A investor and I've been around Series A investing for a long time, and it is a really tough Series A environment right now, is both actually when we're talking about investing and then post-investment, we sit down with our entrepreneurs and we basically say like, okay, our plan says that we have 16 months of runway or something. Like let's chunk it out backwards and set priorities in terms of like key hires or metrics that we need to have either like in the community or in terms of revenue and margins, stuff like that, so that we know in 12 months this is where we're going to be and that we'll be in good shape for a Series A. And then we basically just line up against those priorities. And so we have kind of quarterly priorities, whether they're like biz dev ones, hiring ones, marketing ones, PR ones, stuff like that. And then we like sign up for homework assignments or connecting them with people who can be more helpful than we can be. It's kind of like, yeah.
So for the investors in the crowd, how should they find their value add? Should they be looking at like what they've done in the past? Should they be trying to go out and learn something? Should they be either working to find a value added service in maybe executive recruiting or design or something that they can add? Or like how do you find your own superpower as an investor?
Oh, that's a really good question. I think what I see in terms of like the most successful kind of companies that seem teed up to do a good Series A and kind of be professional and ready to scale to the next level is these financing rounds are generally not party rounds with no lead. Right? I think they tend to have at least 1 or 2 leads, even 2 or 3 kind of anchor investors, and then a good number of individuals who tuck into the round. And sometimes they're just low maintenance individuals where they don't tax the entrepreneur, and entrepreneurs love that. I think it's the tax that a lot of entrepreneurs feel like they wish they had known before they raised the round, like how much overhead investors were going to cause. And then I do think that a lot of people who have the capital to be able to be angel investors, it's because they were really successful at something, right? Either they're like a technical expert, a PR expert, a marketing expert, a product expert, and that's usually how a lot of entrepreneurs think about putting these rounds together, is like finding someone who really knows financial services and being able to offer time. Even, to be honest, I think Less so at seed than at Series A, but I find like at Series A, no matter how hard you try to be, like to create a lot of trust and like kind of patience and transparency with the entrepreneurs, a lot of entrepreneurs do feel like if you're a board member, there's like a wall, right? And like there's certain things that you can tell board members and certain things you can't. And so entrepreneurs need people to vent with, right? Or bounce ideas off of, and like just go get coffee and say like, hey, I'm thinking about this, and like no stupid ideas. And a lot of times they won't do that with a board member. And so I think being kind of a personal advisor or a coach to a CEO can be super valuable.
So speaking of stupid ideas, what is it in a pitch? What do you look? What are your red flags? You know, it can be really obvious that they're like, or it can seem like, oh, the startups, everything's going great. But what are the things you're like, oh, they said that one thing, and I'm terrified now. I'm running the other way.
Yeah. You know, especially at seed, I'm finding like there's a lot more like shades of gray in terms of like your filter than at Series A. And I'm still trying to figure that out, to be honest, because like seed stage entrepreneurs are just by definition much more raw, right? They're often more naive. They're not as well trained, right? They don't know how to run a board meeting yet necessarily, or like they don't know how to kind of story tell. I think that like a lot of also what we help seed stage companies with is teaching them how to be better storytellers. Right? Because like when you go into Series A, you need to like, you know, you only have really like your first 10 minutes with the Series A investor, and like how you tee up who you are and why you're qualified to do this and what you've accomplished is like they're either going to be like sitting forward in their chair or like when is this meeting going to be over in like the first 10 minutes. And a lot of the entrepreneurs aren't that good at it, but I would say, I mean, you know, obviously ethics is kind of an easy one, right? Sometimes entrepreneurs are like, I mean, even that is almost a little gray, right? Because you think about like YouTube and Zynga and a bunch of other companies that have gotten really big. Sometimes, you know, they look the other way on certain stuff to kind of scale up, right? So there's kind of a little bit of a gray area there, but obviously like some ignoring key ethics stuff, I would say, you know, you want them to be aggressive, but not unrealistic. Like we saw this venture last week where the revenue plan was like 3 million this year, like 45 million next year, like, you know, 120 the year after, and then
Were
750.
they selling unicorns?
Yeah, exactly. It just doesn't happen, you know, and so it's kind of a good litmus test. But I would say that's one of the interesting, tricky things about being a tech investor is a lot of the best ventures did not sound so great at seed stage. You know, they sounded kind of crazy, and a lot of times the entrepreneurs are actually not super buttoned up, and they may be like wild storytellers. You know, so you kind of have to decide like, is this person kind of like good crazy or like not likely to be successful crazy? And I think that's one of the tricks to doing this. You interview a lot of these entrepreneurs, right? And sometimes at seed stage. Like, would you say that that's the case? Like, do they come across always like super buttoned up to you?
No, I think a lot of them feel very off the cuff, and there's a lot of things that they don't quite understand either. They don't really get how to make it their product into a business. They don't know how to grow the product, or they don't know how to actually build a team and a company.
Right.
Those are some of the big flags. It's like if they've got all three of those things locked down, I'm a lot more interested in, you know, taking their pitch or writing about them.
Yeah.
Because if there's one of those areas that's really nebulous, you start to worry like, okay, am I going to have to like, would they have to get replaced as a CEO down the line? Is their product just going to stumble and never gain any traction? Are they going to gain traction and never learn how to make any money off of it?
Right. So the other thing I'd add to that is like, because you need a mix of like vision and also execution. And some CEOs who come across as really professional and good storytellers, really good executors, but they don't have the ability to actually think of the next idea if the first idea doesn't work. You know, and so like it can be almost a mistake sometimes to invest in the people who are just really good executors because they're easier to work with, but they actually don't have like the magic.
Maybe you could do this in like an anonymized, privacy-safe way. Like, what was your worst investment? You're like, what was, or tell us a story of a pitfall you walked into. You don't have to say what company it was or what industry, but like what sort of the narrative was that led you to think it was going to be great, and then they ended up being totally terrible.
Okay, I think this is one I won't get too much trouble for, but it's a KP story, which is there was once this two-wheeled self-balancing scooter company that we invested in.
What company could that be?
And I was pretty new at investing. Like we invested like in probably the first year after I joined the firm, and I was working with such luminary people who are so much smarter than me that I never really spoke up when I thought that like $8,000 is a crazy amount of money for any individual person to spend on a self-balancing scooter. And I should have said something. Like I don't know if anyone would listen to me because I was just this like rookie, like MBA girl, who hadn't, built a giant company before. And, if you've put $1 billion of returns on the board, people tend to listen to you a little bit more than like the rookie. So, but I think I was a little too deferential. And, I used to work for a guy named Mickey Drexler at The Gap, who is an amazing CEO. He runs J.Crew now. And he used to tell me, like, in his very Mickey way, like, if you're feeling it, it's happening. Like, if you have a feeling in your gut, you shouldn't be afraid to say it. And I just think that's something that's taken me a long time to learn.
Yeah, it can seem like a good idea to just be polite or, think that maybe you're crazy and that everyone else understands this and you're the one that's wrong. But this is a business. It's not supposed to be friendly all the time. And so I think when you have one of those gut feelings, you have to ask the entrepreneur, like, straight out, like, okay, how are you going to sell this at $8,000? Like,
right.
Segways are fun. I mean, whatever, two-wheeled scooter self-balancing companies are fun. I danced on one recently. It's really fun to dance on those things.
Actually,
not really useful for transportation.
Polo on a field with them is awesome.
Great. So you got like about 200 polo players in the world who want this.
Steve Wozniak is a very large market.
All right. So let's talk a little bit about equity crowdfunding. What do you think this is going to do to the industry? Is this changing things? Like, well, this is FundersClub's conference, and I want to know if FundersClub is going to work or not. So I'm going to ask you.
I'm here because I met FundersClub through a portfolio company. So we had a portfolio company in e-commerce, which is a great company. But as you guys probably know, e-commerce has just been like, venture investing is like, I came from the fashion business before I joined Kleiner, and like the fashion business is way more similar to venture capital than anyone realizes because it's like it's a very like tail wag the dog industry where like the companies that are doing well in the public markets tend to do better for early stage investors for some reason, which makes no sense at all. And like investors tend to kind of flock really quickly from one sector to another. So e-commerce has just been having a hard time. And even though this company has very good metrics and a fantastic management team, we decided rather than to put them through the pain of trying to raise money from traditional Series A investors, we would lead an inside round, but we wanted to fill it out with some new people. And we talked to FundersClub, and they were fantastic to work with. And our entrepreneur is thrilled that FundersClub's involved, and that's how I met them. So we're working together.
So FundersClub isn't the apocalypse for venture capitalists?
No.
Okay.
No.
That's good. No, it seems like a really great way to I think it's a great way to augment your round. It's like I don't think you want to go all with equity crowdfunding because you want really skilled operators, people who've been doing this for a long time, people who can have those inside connections in Silicon Valley, have those big teams that can help you with recruiting or design. But at the same time, having an army of investors, having people who can be testers, evangelists, networkers, things like that, that's really helpful for a startup. And I think it takes a village, right?
Yeah, it does take a village.
Okay, so let's take some questions from the crowd. I want to hear what you guys have to ask for Aileen.
Hi. Thanks for taking my question. With the entrepreneurs you're dealing with at the seed stage, they're often naive when it comes to financing, and when you want to invest in them, do you feel like you have a standard set of terms you present them, and do you feel like you have more negotiation power because you've been doing it for so long and they have really just come about to raise their first round of funding? So how does that work, and do you feel like you have more power sometimes, or?
No, I have no power. I'd say in this environment, I mean, even, you've got junior high kids who read TechCrunch, right? And so, they come into it pretty savvy and oftentimes with, higher valuation expectations than I think I'm hoping for but part of it is because I know, I think a lot of times entrepreneurs, it's starting to catch up with people is like, there's a lot of ego attached to getting a high valuation and raising a lot of money, right? It's kind of like there is a little bit of an entrepreneur culture where it's like, I played my investors, but it does catch up with you because if you have a seed stage company, you raise $1.5 million at 10 pre, right? Even if you're able, and I think for individual investors, it's important to be cognizant of this because you may be psyched that you're getting into a hot deal that's kind of expensive, but you're getting in and so you're excited. You're at 11.5 post the financing, right? So for a Series A investor to invest in an up round from that, because that's what will make the team feel motivated, because they're going to want to keep that mojo. Like we did such a hot seed deal, we have to do a hot A deal. So that means our A has to be 20 pre. They have to accomplish a tremendous amount on the $1.5 million. And I think in a lot of cases they're not. And so they're having to do down rounds or seed extensions at flat rounds, and that doesn't make anybody feel good, and it catches up with you. So I think it's more that conversation and like talking about how this is a long game. I mean, if you study like the companies that are worth over $1 billion today, like they're generally 8 to 10 years old. This is not like, I mean, Instagram is like a red herring in terms of how long it takes to build $1 billion company.
And if you go into investing and you try to game your investors, you just end up like it's a closed ecosystem to some degree. It's like, yeah, sure, that company ends up getting like growing, selling. They work at the company for 2 years, and then you're back out on the street raising money again. So people are going to remember that. So another question?
Yeah, I'm running an angel group in health tech, and one of the problems we've seen is tech VCs really throwing the 100K to 150K debt, no cap, and we walk away because the entrepreneurs are, they're getting this free money unsupervised, and it usually is a disaster. So can you help us there? I mean, what are your thoughts?
It's funny. I actually feel, I've seen that a little bit more the other way, where I feel like individuals are more willing to invest in no-cap ventures than institutional folks. Because we have not, and I hope we will not invest in a no-cap. No, because it doesn't make a ton of sense for an investor, like an institutional investor. Now, and I have said this to my friends at traditional venture firms, is like they're not helping themselves by throwing 100K into a bunch of deals where they validate the round before there's a lead. I'd rather that, and I think I'm glad that Greylock and AH and other people are putting money into seed companies, but I'd rather they say, go find a lead and have the lead set the price, and then I may come in, rather than entrepreneurs being able to walk around town and say, the price is 12, Greylock's in, right? And I think that that happens by accident sometimes. I don't think that's the intention of the venture investors, because they know that that's a bad setup for the rest of kind of the venture ecosystem. And so I feel like that hopefully will get adjusted a little bit this year, because they know that doesn't make sense.
So to recap some of the things I think we learned, when you're trying to add value, look at what you've done before and find how that can be applicable to the startups you're investing in. When you're making introductions, make sure to vet them both ways first. Always set expectations properly. Don't overpromise and underdeliver. Check. And if you have concerns about a self-balancing two-wheeled scooter, you should voice them. Exactly. Speak up and ask the questions. If there's something weird in your gut that feels wrong, like ask and ask and ask until they tell you an answer that convinces you to invest or not to. Well, thank you guys for listening. We got to finish up because there's other great speakers coming. We're going to have a break in a few minutes. We'll be around to talk. If anyone has something cool to tell TechCrunch, come and meet me afterwards. But otherwise, thank you to UPROUND.
Yeah, thank you guys.